When I started out, I used to do a lot of what Phil Fisher described. I followed this scuttlebutt method. As you're acquiring knowledge about industries, there really isn't anything like getting out, talking to competitors and customers, whatever it may be.
That is Buffett talking about the extremely underutilized methodology he uses to analyze companies, the scuttlebutt method. Making a financial model can essentially be done in 30 minutes, but actually figuring out the market in which a company operates and building the confidence necessary to make a high conviction bet is best done by following these 5 rules of the scuttlebutt method. Before I get started, maybe I should explain what is scuttlebutt. Scuttlebutt is slang for rumors or gossip. Not unlike high school, the business world is also full of gossip, people that are happy to share the inner workings of any industry. Phil Fisher's scuttlebutt method dictates that this aspect of human nature can be harnessed to get to the heart of whether a stock is a good investment or not. So how can you take advantage of the scuttlebutt around your stocks? Rule 1, have an owner's mindset. Imagine you're buying a small business, not just a stock certificate, maybe your corner ice cream shop. Before buying, you'd do the following. First, you'd ask for the financials to make sure the business is making money and is actually worth buying. You'd be able to use this to get a rough valuation of the business. You'll also be able to see how the business has fared in the past, looking at its financials over the years. You might notice the business loses money in the winter and makes most of its money in the summer. You might even see that the business sales have done well through the last recession, allowing you to feel more confident in its long-term prospects. Unfortunately though, the financials can only tell you so much and are always backwards looking. Your job is to divine the future. So what else do you look at? You'll probably want to try out the ice cream, see if you like it, maybe even ask your friends, do they like it? This look into the product itself could reveal major issues hidden underneath the surface. Who are the competitors and why do people go there instead of your target business? Does the competition have something you are unable to beat? Maybe look at where they get their ice cream. Talk to the vendors to see if they pay on time. You might find that sitting outside and counting how many people go in is a great way to double check the financials as well. Chances are the financials are right, but what's the harm in checking for yourself by staking out the store? Now in this example, I've shown you many of the types of things I've done when buying small businesses in the past, and they often seem so obvious when thinking about a single ice cream shop or your corner deli. Phil Fisher though believes this same methodology, the owner's mindset, should be applied to your stock investments as well. The thought is, why wouldn't you do the same when buying a piece of a larger company? Rule 2, talk to everyone. Naturally, we surround ourselves by people that think like us. The thinking is further reinforced in today's world of social media. As the algorithms that serve you and the videos you watch get to know you better, they will show you more of what you agree with versus not. In order to get an objective view of any company you're analyzing, you'll need to break out of this echo chamber. Specifically, you'll have to talk to people of all ages throughout the company's ecosystem, from customers to employees to vendors and competitors. By breaking out of this echo chamber, you'll find new angles to any stock that may break or make your investment. Interestingly, Warren Buffett's most profitable investment to date, Apple, began with the scuttlebutt approach to the stock. At the time, the 90-year-old David Sandy Gottesman, a director at Berkshire Hathaway, had lost his iPhone when it slipped out of his pocket during a taxi ride in 2016. Despite his age, he confessed to Buffett's deputy, Ted Wexler, "I felt like I lost a piece of my soul." Wexler shared Gottesman's story with Buffett, who was surprised to learn one of his friends was so taken with such a technical device at his old age. Buffett also noticed how obsessed people had become with their smartphones when spending time with his grandchildren during their weekly trips to Dairy Queen. He determined the iPhone was indispensable to many people and that it was unlikely to change anytime soon. At the time, Wexler had already built a $1 billion position in Apple at Berkshire. Buffett added $35 billion into Apple stock after realizing Apple was similar to Coke in its long-term growth potential. This investment has gone on to net Buffett $100 billion over the last 6 years. Rule number 3, build your hypothesis and then try your best to disprove it.
You should be like a basketball coach who runs into a 7-footer on the street. I mean, you're interested to start with. Now you got to find out if you can keep him in school, if he's coordinated and all that sort of thing. That's the scuttlebutt aspect of it.
Before employing the scuttlebutt technique, Buffett first recommends finding a stock that has already met your analytical guidelines. You've read the annual reports and financial statements, and you believe you have something special that will give years of growth or compounding ahead in the business. Maybe it's the next Apple, or maybe you heard a great pitch on yet another value blog and you're digging deeper. Now that you have a stock you would like to invest in, this is where scuttlebutt comes in. Your job is to speak to those that have deep knowledge of the industry or company and try to disprove your own thesis. Why disprove instead of prove the thesis? Because in most cases, you formed your opinions from the curated information provided to you by the company's management and investor relations department. It's their legal responsibility to present the company in its best light. Without further evidence, you need to approach this investment with skepticism. Take, for example, Warren Buffett's investment in American Express in the 1960s. He felt that the salad oil crisis was overblown in the market, and the $125 million decline in the stock wouldn't last long. To try to disprove his thesis and see if he could find an alternative reason for the stock to be down, he employed the scuttlebutt approach. In his conversations with all kinds of people, from customers to vendors, he found he was even more convinced of his investment and bought more as he did more research instead of less. Once it was apparent that the salad oil situation was manageable and that the underlying business was unaffected, the American Express stock started to recover. Amex was a huge position for the Buffett partnership. Once the stock started to appreciate, it grew to 40% of the total portfolio. As Buffett was proven right, he started to exit the Amex position. It had taken 5 years to play out. Buffett had paid the equivalent of 94 cents per share for the stock and sold in the $5 range. Point number 4, find the silver bullet company. Now that we know who to talk to and how to approach these conversations, the question is, what kind of questions do we ask? Insiders in any industry will inevitably know much more about parts of that industry than you will. A great way to find out if you're investing in the right company is to ask insiders this question. If you could eliminate one competitor or substitute with a silver bullet, who would it be? Preferably, you want to be investing in a company that is destined for the silver bullet, not the one firing. On the flip side, Andy Grove mentions when the answer to this question becomes unclear, then something in your industry is changing, creating an opportunity for those best positioned. You can apply the silver bullet test to other competitive forces as well. Which customer or supplier would you save first? If you ask enough people in the industry what competitor they fear most, you'll end up knowing more than many insiders alone. At the end of the day, everybody loves talking about their competitors. And if you do that with 10 different companies, you'll probably have a better fix on the economics of that industry than any of those individuals. That is the power of the silver bullet approach. Point number 5, keep it confidential. Last but not least, often valuable information is not so simple to get when speaking to employees at public companies. Getting valuable information from those that know best is difficult and may get people in trouble. Phil Fisher says the inquiring investor must be able to make clear beyond any doubt that his source of information will never be revealed. Then he must scrupulously live up to the policy. Otherwise, the danger of getting an informant into trouble is obviously so great that unfavorable opinions just do not get passed along. Scuttlebutt research can be done in many ways. For larger companies, many investors use expert networks like GLG and Thesis. These expert networks allow you to connect to experts in each industry without having to necessarily reach out by cold calling. For consumer-facing companies, you can always buy the product and ask your friends and family about it. Some investors even go further by building website scrapers to monitor online sales and competition for these types of companies. To learn more about an investor that digs deeper than most and has 3 times the return of Warren Buffett over the last decade, check out my last video on why Cliff Sosin is betting it all on Carvana stock. Thanks.